1 more year has a recurrence rate above 90%. That is not a rough estimate. That is what behavioral economists find when they track workers who said they needed 1 more year. Most of them say it again 12 months later. Same phrase, different excuse. And here is what they never tell you up front. Financial institutions track this pattern very carefully, not to help you escape it, to forecast how long your assets stay under their management. Because every year you delay withdrawing, they collect another year of fees. Your indecision is their annuity. And there is a specific mechanical process that keeps you on that loop, designed by people whose income depends on you never quite reaching the finish line. By the end of this video, you will know who those people are, exactly how the trap works, and the 3-number test that tells you whether you are working past 61 because the math requires it, or because someone engineered a feeling that feels like math. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Now, let me introduce the one idea that is going to run through everything today. The moving finish line. You know those charity fun runs where someone promises you the finish line is right around the corner? You round the corner and the finish line is not there. So you keep going. You round another corner, still not there. Except nobody is telling you it moved. You are running the same race with a shifting endpoint and no map. That is not a race. That is a treadmill with flags on it. Most people's retirement plan looks exactly like that. When you were 45, the target was $400,000. You hit it and someone ran a new projection, $750,000. You hit that and the calculation changed. And now $1 million is the safe number. Then $1.2 million, then 1.5. The finish line keeps moving. And here is what nobody says clearly. The people selling you the new finish line are not doing it to protect you. They are doing it because a bigger target keeps you in accumulation longer. And accumulation is where they get paid. The moving finish line. Remember that phrase? It is coming back. In a few minutes, I am going to show you the exact bucket system that tells you which type of worker past 61 you actually are. But first, let me explain why the most common piece of advice about this is more broken than you think. The common advice is, if you are worried, work a little longer. More income, more contributions, more time for the market to recover. That gets repeated by financial planners, HR departments, and personal finance articles with stock photos of smiling 60-year-olds in kayaks. Here is the problem. Working longer is not a retirement plan. Working longer is a way to avoid making a retirement plan. It is the financial equivalent of cleaning your apartment when you have a deadline. It feels productive. It is not. There's a man named Harold. Harold is 63. Harold has been saying, I will retire when I hit $800,000 for about 6 years now. When he had $400,000, the number was $400,000. Then he got there and an advisor showed him a Monte Carlo simulation. The new number, $750,000. He got to $750,000. The advisor recalculated. Market conditions had changed. The safe number was now $900,000. Harold is sitting at $740,000 and saying maybe next year. Harold is not stupid. Harold is on the treadmill. And the treadmill feels like progress because you are moving, you are working, you are responsible, you are not retired, which means you have not made the scary decision yet. The finish line moved again. It always does. Now there is a story from 1963 that is the clearest version of this trap I have ever found in American history. South Bend, Indiana, a cold morning. Men in work jackets walking into the Studebaker plant that had been part of the city for decades. These were not careless people. These were not people who ignored planning. They had made a deal. Show up every day, do your job, be loyal, and the company will take care of you when you are old. The pension, the guarantee, the promise. For years, the deal seemed real. The plant was running. The paychecks came. And the pension was this future certainty sitting in the background, something you did not think about because the company was handling it. That was the entire point. But behind the numbers, the pension fund had a problem. It was underfunded. The gap between what the company had promised and what had actually set aside was enormous. And here is the specific trick about underfunding a pension. It is invisible debt. You borrow from workers' futures without calling it a loan. The workers do not see it because it does not affect this week's paycheck. It only affects them later. And later feels manageable, right up until the moment it does not. In December of 1963, Studebaker shut the plant. The pension plan could not pay what was promised. Over 4,000 workers, many of them close to retirement, discovered that the guaranteed income they had built their futures around was not guaranteed at all. Workers close to retirement got partial benefits. Younger workers got almost nothing. Some estimates place the unfunded gap in the tens of millions of dollars. Creditors were paid. Executives kept their protections. The line workers held the loss. Sit with that for a second. Those workers did everything right. They stayed, they were loyal, they kept working because they believed the promise would hold, and loyalty did not protect them. Because they were trusting a promise instead of auditing the structure underneath it. The safety was never in the guarantee, it was in the fund, and nobody was checking the fund. Now, you might be thinking, Tom, that was over 60 years ago. Pensions are mostly gone. What does this have to do with me in 2026? Everything. Because the modern version of the Studebaker Promise is not a gold watch or a pension statement. It is the narrative that if you keep working, you will eventually be safe. And that narrative is just as underfunded as that pension was. It looks solid from the outside. It feels responsible. And it serves everyone's interests except yours. The Studebaker workers lost their retirement not because the plant closed, but because the structure they trusted had a hole in it that nobody showed them. You have access to information they never had. The question is whether you use it before the plant closes. This is where it gets really interesting. Because here is the statistic that should genuinely make you uncomfortable. Research on high net worth retirees shows that many people with substantial assets, we are talking multiple millions of dollars, report feeling financially insecure. In survey after survey, respondents say they would need roughly double what they currently have to feel truly comfortable. A person with $3 million believes they need $6 million. If they had $6 million, they would probably say 12. This is not a rare personality quirk. It is the average response to a system that profits from the feeling of scarcity. The finish line moves not because the math requires it. The finish line moves because your fear is a product and someone is selling it to you. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now let me name the system clearly. Because if you cannot see the system, you will keep reacting to individual symptoms instead of solving the root. I call it the fear economy. And I want to be precise here because I am not a conspiracist. I find this stuff amusing in a darkly resigned way, not enraging. The fear economy is not a shadowy group making decisions in a bunker. It is much more boring than that. It is incentives doing exactly what incentives always do. 3 moves. Move 1, keep the complexity high. If retirement planning feels impenetrable, you need experts. If you need experts, someone gets paid. Complexity is not a problem being solved for you. Complexity is the product. The more a financial advisor can make your situation feel uniquely nuanced and dangerous, the more indispensable they become. So the math never quite resolves. There is always one more variable, one more scenario to run, one more risk to account for. The analysis never ends because ending the analysis would end the engagement. Move 2. Anchor you to a bigger number than your life actually requires. They show you a retirement budget that includes everything you could possibly spend. They blend your baseline needs with dream scenario spending. They add healthcare projections that may not apply to your specific situation. They account for inflation scenarios built on worst case assumptions. And then they point to a number that is probably 50 to 100% higher than what your actual life requires. And you nod, because you cannot argue with math presented in a format you do not fully control. Move 3. Focus your attention on market risk and hide fee risk. Market headlines are terrifying. Bears are always coming. Recessions are always 3 months away. But fees are silent, invisible, and completely certain. A 1% annual fee on $200,000 does not feel like anything. It sounds like a small administrative cost. But over 30 years, assuming roughly 7% market returns, that 1% fee does not cost you 1% of your portfolio. It costs you approximately $170,000 in loss compounding. That is not a rounding error. That is a decade of gap coverage for some people. And nobody writes a scary headline about it because the fees are what pay the people writing the content. You think market volatility is the problem. Market volatility is temporary and partially recoverable. Fee drag is permanent. It compounds against you in silence every year, regardless of what the market does. The certain thing is the one nobody talks about because the certain thing is what pays them. Now let me give you the framework that cuts through all of it. I call it the 3-number test. If you are working past 61, these are the only numbers that actually matter about your retirement math. Number 1, your monthly baseline spend. Not your dream spend, not your what if we travel more spend, your baseline. The amount your life actually costs when it is running normally. Housing, food, insurance, utilities, transportation, healthcare out of pocket. The real number. Most people have never written this down. Most people are managing their retirement against a number they have never precisely identified. Number 2, your guaranteed income floor, Social Security, pension if you have one. Any rental income that is truly reliable after costs and vacancies. Any annuity you already own. The income that shows up every month, regardless of what the market does. And here is a specific lever worth knowing. Delaying Social Security past your full retirement age increases your benefit by roughly 8% per year, up through age 70. Not 8% return on your portfolio, 8% more income every month for the rest of your life. If your health allows it and you have a bridge plan for the gap years, that math can be one of the best guaranteed returns available anywhere. Number 3, your gap. Baseline spend minus guaranteed income floor. That number is what your portfolio has to cover. And the reason this test is so clarifying is that it separates the real question from the manufactured feeling. Because the feeling says you need $1 million. The math says you need a specific withdrawal rate on a specific gap. Those are very different conversations. Let me run this on a real scenario. Imagine Dennis. Dennis is 62. He has spent the last 4 years as a project manager at a logistics company. He has been saying 2 more years for 3 years running. His portfolio sits at around $550,000. He assumes he needs $1 million to retire because that is the number the internet keeps suggesting. He has never run the 3-number test. Here's what the 3-number test actually shows for Dennis. His monthly baseline spend is $4,800. He is not extravagant. That is his real number. His guaranteed income floor, once he claims Social Security at 65, will be around $2,200 a month. His gap is $2,600 a month. That is $31,200 a year. Now here is the math on what Dennis actually needs. At a conservative 4% annual withdrawal rate, to generate $31,200 per year, Dennis needs $780,000 invested. He has $550,000. He is $230,000 short. Not $450,000 short, not $1 million short, $230,000. At his current savings rate of roughly $24,000 a year after everything, and assuming flat markets with no growth at all, Dennis is 9 to 10 years from his number. With reasonable market returns, maybe 5 to 6 years. Still not tomorrow, but a real timeline, not an open-ended drift. But here is where it changes completely. Dennis has a house with $300,000 in equity. His children are grown. He has a spare bedroom being used as a storage room and a car payment on a vehicle that is significantly more car than his life requires. If he makes 2 decisions, pays off the car early and downsizes to a smaller home, he can free up roughly $150,000 in equity and reduce his monthly baseline by $700. New baseline, $4,100 a month. New gap, $1,900 a month. New annual gap, $22,800. Portfolio target at 4% withdrawal. $570,000. Dennis has $550,000. He is $20,000 away from his retirement number after 2 simple decisions. With a normal market year, he is there. Dennis does not need to work another 5 years. Dennis needs clarity and 2 decisions. The finish line was never at $1 million. That was a number the internet planted in his head that bore no relationship to his actual life. Now you might be thinking, Tom, what about healthcare? Dennis is 62 and Medicare does not start until 65. That gap is real. It is not nothing. But here is what most people never do. They assume the answer is impossibly expensive and they stop there. They never get a real quote. They let an unknown become a permanent jailer. The healthcare bridge for 3 years matters and it is solvable. Marketplace plans exist. Subsidies are available at certain income levels, and if you structure your early retirement income carefully, you may qualify for meaningful cost reduction. There are COBRA options for short transitions. There are spousal plans for some people. There are healthcare sharing arrangements worth understanding. I am not giving you a one-size-fits-all answer because your state, your health history, and your income structure all matter. But the principle is this: do not let an unknown become a reason to keep working indefinitely. Unknowns are assignments. Get quotes, run numbers. The answer might surprise you. Now here is the part that most financial content never addresses with enough honesty. And this is where I want to introduce someone. There is a man I will call Raymond. Raymond is 64. He is not short on money by any objective measure. His 3-number gap is covered by his portfolio with room to spare. His health is fine. His wife has been quietly ready for him to stop for 3 years. His adult kids think he should stop. His doctor mentioned that stress was showing up in his blood work. Every objective signal points toward the door. But Raymond cannot stop, and he cannot name exactly why. He talks about wanting a little more cushion. He says the market feels uncertain right now. He mentions that they might want to travel more in retirement, so he needs to build the income. Every month, there is a different version of the same reason, and none of them are quite convincing, even to Raymond himself. I know multiple Raymonds. You probably know one too. Maybe you are one. Here is what is actually going on in Raymond's head. Raymond's identity is constructed from work, specifically from being the competent one, the provider, the person with a title and a clear role and a problem to solve on Monday morning. For 40 years, Raymond woke up knowing exactly what success looked like that day. Take that structure away, and Raymond does not know what Tuesday morning looks like. He does not know what winning means when there is no scoreboard. That is not a character flaw. That is a completely human response to a transition that our culture almost entirely fails to prepare men for. We build an entire identity architecture around production and performance, and then we tell people to abruptly stop and relax and enjoy it, as if the psychological infrastructure that took 4 decades to build can be dismantled with a retirement party and a fruit basket. So Raymond does what any reasonable person does when facing a genuinely scary transition. He manufactures a financial reason to delay. And money is the perfect excuse because it is always improvable. You can always have more. The finish line can always move another 6 months. And Raymond is a responsible man. Responsible men plan carefully. Responsible men do not retire until the math is right. Except Raymond's math has been right for 2 years. The finish line is not moving because of the numbers. The finish line is moving because Raymond does not know what is on the other side of it. Raymond is going to come back at the end of this video. His story resolves. But first, I need to give you the part that makes bucket 3 people, the Raymonds of the world, actually move. Here's a statistic that very few people internalize even when they read it. Multiple long-term studies on retiree spending behavior show that many retirees die with most of their money still intact. Not because they were investment geniuses, because they were scared. Retirees, especially those without traditional pensions, consistently spend far less than their financial models projected. They withdraw less than the 4% rule would allow. They hoard, they underlive. They leave estates much larger than they intended because the fear they carried into retirement never left. Think about what that means concretely. A meaningful percentage of people who kept working past 60 because they were afraid of running out never ran out. They spent their healthiest, most physically capable post-work years in a state of low-grade financial anxiety, denying themselves experiences and time and rest, leaving behind money they never used for things they never did. That is not responsible. That is a tragedy built from engineered fear. And here is the second statistic that belongs next to the first one. The research on health outcomes in retirement shows that for people transitioning from high-stress, low-autonomy work, retirement is associated with measurable health improvements. Lower cortisol, better sleep markers, reduced cardiovascular risk, more time for physical activity and social connection. The year you are working to generate $60,000 post-tax may be silently accumulating costs that show up as higher medical bills in your early 70s. Nobody runs that calculation. They run the income calculation, and they ignore the health externalities because health externalities do not appear in a spreadsheet until they do. Now, let me explain sequence of returns risk in a way that actually lands, because the phrase itself sounds like something an actuary says to avoid being interrupted at a dinner party. Here is the version that matters. Imagine you own a rental property worth $300,000 with a $150,000 mortgage. Solid equity position. You feel good. Now, you decide to renovate the kitchen using a home equity line for $50,000. Not because you need to, but because someone convinced you it would add value. Fine, new kitchen looks great. Then the real estate market softens. Your property drops 20% in value, now worth $240,000. Your mortgage is still $150,000. Your equity line is still $50,000. You owe $200,000 total. Your equity went from $150,000 to $40,000. Nothing changed in your daily life. You still live in the same house, but your financial position changed dramatically because you layered borrowing on top of a structure without protecting the downside. That is what retiring without a cash buffer looks like. You think you are fine because your portfolio is healthy. You retire, you start withdrawals. Then a significant market decline hits in year 1 or year 2. Your portfolio drops and you are pulling money out at low prices simultaneously. Each withdrawal locks in a permanent loss. The portfolio shrinks faster than the model projected. And now you are making decisions under stress, which is the worst time to make decisions. You sell equities at depressed prices. You cut spending in ways that feel humiliating. Or you go back to work, except now you are 2 years older and the job market is less forgiving. The market drop is not what ends the retirement. The forced selling at the wrong time is what ends the retirement. The timing is the problem. So here is the fix. And I want you to hear this clearly because it is not complicated. It is just underused. Build a bridge bucket. A bridge bucket is a pool of stable, low volatility assets, meaning cash, short-term government bonds, stable value funds, something that does not move dramatically when equity markets sell off. You size it to cover your spending gap for roughly 2 to 3 years. Not your total expenses, your gap, the portion your portfolio needs to cover. If your gap is $2,400 a month and you want a 2-year bridge, that is $57,600 in stable assets on a $500,000 portfolio. That is under 12% of your total in the bridge and over 88% in growth-oriented investments. Not dramatic, not even conservative by most standards. But that 12% buys you something no investment return can buy after 61. Time. If the market drops 40% in year 1 of your retirement, you reach into the bridge, cover your gap, and let your equities recover. You are not forced to sell. You are not making decisions from panic. You bought yourself 2 years of market recovery runway and the ability to sleep at night. That is worth more than the marginal return you give up by not having that money in stocks. Now, the objection that is probably forming, cash and bonds earn less than stocks. You are losing returns. Yes, that is the point. You do not complain that your car insurance only costs you money. You pay it because the catastrophic downside is unacceptable. The bridge bucket is insurance on the timing of your retirement, not an investment strategy. It exists to eliminate a specific, sequentially catastrophic risk. Stop evaluating it on return. Evaluate it on what it costs you if you do not have it. Here is something else nobody explains clearly. After 61, the tax code becomes a game you can actually play if you know the rules. If you are still accumulating in a traditional 401k or traditional IRA, you are building a future tax obligation that is invisible today. Required minimum distributions start at 73 under current law. If your portfolio grows for another decade, compounding on top of existing contributions, and then you are forced to take large distributions on top of Social Security income, you may find yourself in a substantially higher tax bracket in your mid-70s than you are in today. This is called a tax bomb. It is one of the most discussed subjects in advanced retirement planning and one of the least discussed subjects in mainstream financial content. The lever is Roth conversions. In years when your taxable income is lower, you can convert money from a traditional IRA to a Roth IRA. You pay the taxes now at a lower rate, and you eliminate the future required distribution obligation permanently. The converted money then grows tax-free and is never subject to required minimum distributions. Here is the specific trap. If you keep working at a high income indefinitely, you never create the lower income years. You need to make conversions mathematically attractive. Early retirement is not a luxury. For some people, it is a tax planning tool. The first few years after you stop working, but before Social Security starts, can be the most valuable Roth conversion window you will ever have. And working past 63 or 64 to get a little more cushion might be costing you that window. This is another place where more working does not automatically mean more money. Sometimes stopping creates the tax structure that saves more than the extra income added. A quick moment. There's a piece of retirement industry language that I think deserves some public mockery. Financial services firms have a term for people who retire before a certain asset threshold. They call them undersaved. Not free, not strategic, not well planned. Undersaved. Because in their framework, you are perpetually undersaved until the day you die, still inside the accumulation machine. The more you have, the more you could have had. The finish line moves by design. You are not undersaved. You are playing a game designed by people whose incentive is to keep you in the game. Now, let me give you the 4-bucket diagnostic. Because if you are working past 61, you are in one of these situations and the prescription is completely different depending on which one. Bucket 1. You genuinely need the income. Your 3-number gap is real and your portfolio cannot cover it yet with any reasonable structure. You are not scared. You are actually short. Working longer makes mathematical sense, but it should come with a specific exit target, a calculated number, a date, not an open-ended extension with a moving finish line. Bucket 2. Your gap is covered, but you are genuinely afraid of market risk. You run scenarios and feel sick. You have imagined a 40% market decline and it keeps you awake. You are not short. You are unprotected. And protection is a structural problem, not an income problem. A bridge bucket, a fee audit, a clearly designed withdrawal strategy. These solve bucket 2. Working longer does not. Because your fear is not about the gap. It is about what happens to the gap in a bad environment. Bucket 3. Your gap is covered. Your structure is adequate, but you do not know who you are outside of work. You are Raymond. Your stated reason for not retiring is financial, but your actual reason is psychological. You are telling yourself a money story to avoid a harder conversation. Bucket 3 does not need more savings. Bucket 3 needs identity work and a clear vision of Tuesday morning. Bucket 4. You work past 61 because you genuinely want to. The work gives you meaning, structure, challenge, community. You are not afraid. You have not been trapped. You chose this. Bucket 4 is the only situation that requires no intervention. Now here is the important part. Most people who think they are in bucket 1 are actually in bucket 2 or 3. Most people who think they are in bucket 2 are actually in bucket 3. The buckets mask each other because financial anxiety feels more respectable than identity anxiety. It is socially acceptable to say, I need more money. It is much harder to say, I do not know who I am without this job. The test is simple. Ask yourself this. If your gap was perfectly covered starting tomorrow, if every number checked out, would you stop? Not should you, would you? If the answer is yes, immediately you are in bucket 1 or 2. If you feel a flinch, a hesitation, a but, maybe that has nothing to do with spreadsheets, you are in bucket 3. And now Raymond comes back. Raymond did something 4 months ago. He did not hire a therapist, though that would have been reasonable. He did not quit cold turkey. He answered one question that most retirement planning ignores completely. What does my first Tuesday look like? Not in general. Specifically, where am I at 9 in the morning on the first Tuesday of my retirement? What problem am I working on? What am I good at that day? Who do I see? For Raymond, the answer turned out to be simpler than he expected and more honest than any number he had ever calculated. He had been informally mentoring young engineers for years. It was the part of his job he looked forward to. The teaching, the handoff of competence, the feeling of something being passed on. So the first Tuesday of Raymond's retirement, a consulting arrangement with his former employer. 2 days per month. Specific, bounded, chosen. Paid modestly enough to be meaningful. Not enough to matter financially, but enough to keep a role, a purpose, a scoreboard with a different set of rules. The finish line had been moving because Raymond could not see what was on the other side of it. The moment Tuesday morning had a shape, the finish line stopped moving. He retired 4 months ago. His wife says he is lighter. His doctor says the blood work improved. Raymond says it feels strange in a good way. The money was never the problem. It was never going to be fixed with money. Now, let me give you the 1-hour audit that makes everything actionable. Pull up every account you plan to live on. Every brokerage account, every 401k, every IRA. Do 4 things with what you find. First, calculate your all-in cost. Add the expense ratio of every fund you hold. Add the advisory fee if you pay one. Add any plan administration fees inside your employer retirement plan. If your total is above 1% annually, you are paying too much. If it is above 1.5%, fees are probably costing you more than your investment decisions are gaining you. This is not abstract. This is a specific number that affects your gap calculation and your target number. Cutting fees from 1.5% to 0.5% on a $400,000 portfolio is $8,000 a year, not a rounding error. Second, check for concentration risk. You may own 5 different funds that all hold the same top 10 technology companies. Many broad market funds overlap heavily. Look at the top holdings across your funds. If the same names appear repeatedly, you are not diversified across ideas. You are concentrated in overlapping wrappers. Third, calculate your cash runway. Take your stable assets, meaning money market, short-term bonds, cash, and divide by your monthly gap. How many months of gap coverage can you run without touching your equity portfolio? If the answer is less than 6 months, you have meaningful sequence risk exposure. If the answer is 24 to 36 months, you have a real bridge. Fourth, identify your tax profile. What percentage of your money is in traditional pre-tax accounts, in Roth post-tax accounts, and in regular taxable brokerage accounts? If nearly everything is in traditional pre-tax, your future required minimum distributions may create a tax problem larger than you expect. This is solvable now if you are willing to look at it. After you have those 4 data points, calculate your 1 more year number. Take the asset target you believe you need. Subtract what you have. Divide by what you can realistically save per year after taxes, commuting, and real expenses. That is how many more years you need if markets do nothing. With reasonable returns, the number shrinks. If it is 1, you are close. If it is 2, you are in a genuine trade-off worth analyzing. If it is more than 4, you should look harder at shrinking the gap from the expense side before you assume more years of earning is the only answer. And then ask yourself honestly which bucket you are in, because the bucket determines the solution. And the solution determines whether more working is necessary or whether it is the moving finish line stealing your retirement 1 year at a time. Let me come back to South Bend one final time. The Studebaker workers lost not because they miscalculated. They lost because they trusted a system without auditing the structure beneath it. They believed the promise because it came from a powerful institution. and because questioning it felt disloyal. The structure had a hole in it that nobody showed them. And by the time the structure failed, it was too late to rebuild. The modern version is quieter. There is no plant closing. There is no obvious betrayal. There is the promise that if you keep working, you will eventually be safe. And that promise is held by a system that profits from your delay. The finish line moves, the target grows, the cushion is never quite enough. And another year passes, and then another. If you're past 61, here are the 3 things that actually matter. Number 1, run the 3-number test before you make any other decision. Know your gap, not your total portfolio, your gap. The specific number your portfolio has to cover. Because if you do not know that number, you are managing your fear, not your finances. Number 2, build the bridge. Cover 2 to 3 years of your gap with stable assets before you stop working. Not because you expect a crash, because sequence risk is the one retirement risk you can fully eliminate through structure. And eliminating it costs you less than you think. Number 3, ask the Tuesday question. If you have the gap covered and the bridge in place and you are still not sure, answer the Tuesday question. What does the first Tuesday of your retirement look like specifically? Not in general, not eventually, specifically. If you cannot answer it, that is the work. Not more saving, not more working. That lazy investing built more fortune than crypto memes. And the Studebaker workers deserve to know that the structure mattered more than the promise. You do,